or total permanent disablement for 15 years. This plan also provides guaranteed cash payments starting from the end of the first policy year. This plan is underwritten by Manulife Insurance Berhad. Let me explain further. The Elite Prime Saver Plan provides you short premium payment term of only 3 years, a guaranteed cash payment paid yearly throughout the maximum 15 years tenure. On top of that, you can be assured that the monthly crediting interest rates for the basic account value will never be negative. And you will enjoy a guaranteed lump sum of 180% of standard basic annualized premium or basic account value, whichever is higher at the end of the plan's tenure. Lastly, this is a guaranteed acceptance plan for face amount up to 500,000 per life with no medical underwriting is required. Thank you for taking your time to watch this video. If you want to know more about our Elite Prime Saver Plan, please contact us today. We look forward to your call. Meanwhile, please take care and stay safe.
Dear value customers, thanks for joining the event. I'm King Yong, your MC for today. So far, 2021 has been an interesting year for equity markets. We have seen diverging equity performances between different regions, where the developed markets like the US outperforming emerging markets like Asia. The US and Europe markets are close to their record highs, while the emerging markets like Asia are giving unexciting returns. Moving to the fourth quarter of 2021, there are some burning questions in our mind. These include, number one, will developed markets like the US and EU continue to outperform, or do we expect the Asia to take the lead? Number two, what are the implications to the equity and fixed income market with the upcoming Fed's tapering? Number three, can we expect tech-related stocks to continue their strong performance with the ongoing economic reopening? To address this and other crucial issues, we are pleased and honored to have four highly qualified individuals to join us today for discussions. After the panel discussions, we'll have lucky draw and also event giveaway before we conclude the event. Let me introduce the respective speakers according to the alphabetical order of their first name. First, we have Mr. Darius Fu. He is the head of Intermediary Business Development of Nicole Asset Management. He's currently managing a team that oversees several key relationships in Asia, providing them with product solutions, training, sales, and marketing support. Our next speaker is Ms. Josephine Lip. She is the head of Intermediary Distributions Malaysia of Schroeder Investment Management Limited. Jo joined the company in 2007, and she brings with her more than 20 years experience in mutual funds business. Our third speaker today is Ms. Karen Lim. She is the Managing Director of Southeast Asia Client Group of Alliance Bernstein Limited. Karen oversees the company's retail business for the Southeast Asia region. Our final speaker for today is Ms. Lisa Lee. She's the product strategist of BlackRock Asia Fixed Income. As a product strategist, Lisa represents the investment team in clients' engagements, serving as a link between the investment team and client groups. And finally, we would like to introduce our moderator for today, Ms. Lim Su Lin. She is the head of research of CLSA Malaysia. Prior to this, she has 11 years as the leading ASEAN banking analyst within DBS Group and has had several Asian Money rankings for her coverage over the years. We are going to start the discussion soon. You can type in questions you have in the chat box, which is only visible to us and not anyone else. We will address as many questions as time allows. Let's proceed with the discussions. Sulin, I'll hand it over to you.
Good morning, everyone. Trust everyone is staying safe, mostly at home, given the unprecedented pandemic we are facing today. In any case, this brings us to the topic of discussion for the day. How do we then put our money to work in this current scenario? As introduced, I'm Sulin, your moderator for the day. And with us, and as also introduced just now, we have 4 distinguished speakers, Josephine, Karen, Lisa, and Darius, who will then share their expert views with us. As also mentioned, if you have any questions to pose, please do so in the Q&A box, and we will then address them where appropriate. Without further ado, let us begin. We will now start with a general view on the market, in which we will look at how the US, China, Asia, and global markets will likely perform given where we are facing in this pandemic. We will then move on to invite Josephine and Karen to share their views. Let's start with the question on how do you see the impact of the upcoming US Fed tapering on markets in general for both fixed income and equities? And with the Dow Jones and Nasdaq at its peak, do you then foresee a correction in equities market nearing? Joe, may I pass the mic to you?
Okay, thanks. Thank you, Sulin. Thank you, everybody, for dialing in this morning. Very glad to have all panelists joining us and all valuable clients of Alliance Bank dialing in. So, Sulin, what I'll do is I'll answer the first part of your question first, and then I'll pass the mic over to Karen to share her views as well. So with regards to the tapering and the markets in general, right now, if we look at our models, it continues to point towards the recovery phase. I mean, and also moving ahead, I think the cycle, we think the cycle is really shifting into the expansion phase within the next 6 months or so. Why is this so? Is because the spread of the Delta variant is now more evident in the statistics. So we truly have a clearer picture on what's the impact in terms of growth. And with the higher levels of vaccination, it is also continuing to give a lot more protection to us globally. So we do think that growth globally is on track. The global recovery is staying on track. And with the abundant liquidity in the market, we think markets can continue to trend upwards for now. What do we like more? We like equities more. We like commodities more. We don't like bonds so much. The thing is that the strength of the U.S. economy is giving the Feds a lot more comfort right now, and obviously they're thinking of scaling back QE by the end of this year, and other central banks are doing the same as well. So this is where we are moving into the next stage of the market cycle, and we need to monitor how markets will be moving into the next 3 months, 6 months. But then again, because of the inflation fears that has happened earlier this year, we think that rate normalization will tend to lead to only a small rise in yields. That's what I have for the first part of the question. Over to you, Karen.
Thanks, Joe. Once again, thank you to be invited to present to all of you. I'm Karen Lim. So just to add on to Joe's point, I'm sorry, I hope you can hear me. I think, well, we think, we think that the overriding, objective of Fed is really to exit, QE smoothly without disrupting financial markets. Whereas to Joe, we believe that the hike will be gradual. It's going to be a early 2023 event, so rates will remain low till then. But I really want to remind investors that during tapering, it is not always bad for equity investing. So if history is any guide, if we looked at the last taper tantrum in 2013, when Fed pulled back QE, the market sold off, yes, right? Investors were very, very anxious about the market. But S&P 500, which is a proxy for US equity market, right, saw a maximum peak to bottom sell-off, which is maximum drawdown, of about 6% that year. But guess what? S&P 500 ended the year of 2013 with a positive return of 32%. And similarly, if you look at global stocks, which is represented by the MSCI World Index, they suffered a maximum drawdown of 8% that year, but ended 2013 with a strong return of 27%. So I just want to, remind everyone to say, hey, tapering is not always bad for equity investing. And also at this point, I also like to take a step back and look at the investment landscape today post-COVID. So maybe have the slide, please. So in this slide, investing in the time of COVID-19 and beyond, if you looked at the first chart, we're seeing a peak earning baby boomers moving into retirement. And because of rising populism, if you look at the second chart, right, it was more countries becoming more insular, more domestically driven, and hence we think that global trades is going to plateau and potentially even fall, right? And we're seeing mounting, government debt obligation, in the US and all around. And because of that, we're expecting to see low and lower government yields. We think you're going to get lower returns on your fixed income, and investors will be forced to look into equities to build wealth. But not all equities are built the same, right? So I think the key is to be diversified, to be selected, and be purpose-driven. You certainly, can seek investments that allow you to ride, in the rising markets and potentially give you, downside cushions as well.
Okay, Joe, I think it's back to you for your final
okay.
conclusion.
All right. So you're done, Karen? Okay. So
I am, thank you.
Lynn, all right.
Yes.
So Lynn, your second part of the question is on the Dow Jones and the Nasdaq always hitting the peak day after day, every other day, and the question is it going to crash, or is it going to see a correction very soon? This is one of the most popular questions that we are asked when we meet up with investors around Malaysia. And going back to what Karen has mentioned earlier about what happened in 2014 when the Feds was scaling back on QE, putting the brakes, markets eventually came back and delivered positive performance. And that should be something which is a good start for everyone this morning, very comforting. Because where we are in right now is that we are still in a phase of strong global growth overall. And with regards to the Dow Jones and the Nasdaq, where do we see the direction? I think instead of worrying whether there will be a correction to the index, if you look, it's better to understand these two indices more clearly. Firstly, if you look at the Dow, it has only 30 stocks in the index. And how is this 30 stocks represented in the index is that it is these companies represent a significant portion of the economic activities in the US. And these must be companies that are leading in each of the respective sectors. So these are the 30 companies within the Dow Jones. Very big cap names, very mega cap. Some of the example that I can quote would be like a Pfizer, who is very familiar to us because they provide the vaccines for COVID-19. Microsoft, a very familiar name to all of you, and Procter & Gamble, which is a very big name within the consumer goods. So if you look at the US economy today, this year we are expecting it to expand by about 6.7% in 2021, one of the biggest ever GDP that they can record in the last 20 to 30 years. Next year is still going to be about 4.3%. So it is not surprising that the Dow has continued to trend higher because it is represented by companies that reflect a very big portion of the US economy. And we have seen the Q2 earnings for some of these big companies to continue to stay positive. And due to the positive outlook, they may continue to trend higher. But actually, within the US economy, where are we more excited in terms of the investment opportunities? Dow may not be the best radar for us. We would be more excited to invest in the smaller mid-cap names because these are companies that are directly benefiting from the strength of the US economy, that 6.7% GDP growth that we're forecasting. These guys are generating more than 80% of the revenue from the domestic economy itself. So I think that area would have more chances for investors who are interested in the US market to make more money. So that's about the Dow Jones. The second part is on the NASDAQ. I mean, NASDAQ, if you understand it better, it has about 3,000 stocks within the index. More than 50% is dominated by the tech sector. And diehard investors use this as their radar in terms of where the direction of the technology sector will be. Obviously, in our view, the tech sector has become one of the most expensive sector in terms of valuation since the start of the pandemic last year. And with the Fed's planning to put the brakes on QE soon, maybe this is an area of debate. Maybe investors will target this area as the first area to take profit or sell down first. But overall, what we're saying here today is, like what Karen and I has mentioned, global growth is good. That means companies continue to make money. The investment universe is huge. It's not just about the Dow Jones. It's not just about the NASDAQ. What you need to do in the next phase of the cycle, of the market cycle, is perhaps consider choosing your investment wisely. Over to you, Sulin.
Thank you, Joe. Thank you, Karen. Now, I've seen quite a number of questions being posed, but we will address actually most of them in the next few parts. So may I now introduce Lisa and Darius for the next part to talk a little bit more on Asia and a bit more focused on China. So Lisa and Darius, we'll start with Lisa first then. How has China influenced the world? How do we assess the correlation between the US, China, as well as Asia? And focusing on Asia alone, where do you see growth prospects from apart from China? So Lisa, over to you.
Thank you very much, Sulin. Hi, good morning, everybody. My name is Lisa. Thank you so much for joining today's session. So let me first talk a little bit more on the China fixed income bond market, and then I will pass my mic to Darius, who can share a little bit more from his side as well. So let's go back to the basic first. So fixed income investors nowadays are looking for income. At the same time, they're trying to minimize the beta through diversification. But however, in the current market condition, there's nothing being fixed given the market uncertainties, and there is no income, especially post-pandemics, with the unprecedented monetary easing by global central banks. So we think the China fixed income bond market offers the perfect solution here because, number one, China fixed income gives you much higher yield compared to the other parts of the world. And number two, China bond market offers dual diversification, given its low correlation between China versus other developed market. And even within the China bond market, the correlation between onshore versus offshore is also very low. So let's start with the yield first. If you look at right now for fixed income assets yielding more than 2.5% these days, more than half of them are actually coming from China. So China is becoming a must-to-have asset class in the client's fixed income portfolios going forward. At the same time, this market offers perfect diversification. So Josephine and Karen just mentioned about the Fed tapering by end of the year. We think it's a perfect solution, perfect time to invest into China fixed income bond market given its low correlation against the US market. For example, year to date, the US 10-year Treasury climbed up by 40 basis points. On the other hand, the onshore Chinese government bond yield has dropped by 30 basis points, which actually serve as a great diversifier, great hedge against the rising treasury yields. So moving to the end of the year, we expect PBOC will take a moderately monetary easing to the end of the year, despite the rising US Treasury yields. So the onshore Chinese bond market would actually provide additional capital gain opportunities for the clients. So this is because China and US has different economic cycles. While US is tightening, China is actually on a moderately easing stance going forward. So we think investing into China fixed income makes the perfect sense, especially in the current market environment. The second thing I want to highlight is around the correlation between onshore versus offshore China bond market. So if you can put up the slide. So here on this slide, it shows you the past performance between onshore China RMB bond market versus the offshore China US dollar credit market over the past few years. The blue bar refers to the offshore US dollar credit market performance. The green bar refers to the onshore market performance. So despite both onshore and offshore are part of the China fixed income bond market, historically, these two markets behave very, very differently. For example, back in 2018, the onshore market generated close to 8% return, despite the sell-off in the global bond market driven by the rising US-China geopolitical tension. This is because back in 2018, PBOC has conducted aggressive monetary easing to stabilize economic growth. So the onshore market served as a kind of a risk diversifier hedge against this kind of risk-off events. So similarly, during Q1 last year, especially during the March liquidity crunch last year, the onshore bond market was probably the only asset class which generated positive returns during the March liquidity crunch last year, effectively served as a hedge as well. So subsequently, from Q2 to Q4 last year, the offshore China US dollar credit market outperformed onshore on back of the unprecedented monetary easing by global central banks. So if you have a strategy which can move freely between onshore and offshore, not only you have very little drawdown, but most importantly, you can always generate resilient performance for our clients because of this low correlation between these two markets. For example, within our China cross-border strategy, we have increased our onshore allocation in 2018 as well as back in Q1 last year, so our onshore exposure helped us to mitigate the losses coming from the offshore bond market. And subsequently, since Q2 last year, we have increased our allocation to the offshore market to take advantage of the cheap valuations. So by doing tactical allocation, we can achieve much lower volatility, but at the same time, deliver resilient performance for our clients across all the market cycles because of this low correlation dynamic between these two markets. So now let me pass my time to Darius, who can share a little bit more.
Thanks, Lisa. Very good morning, one and all, for joining us again. I think Lisa has done a really good job covering the entire fixed income spectrum. And I like to say, thankfully, I do have a bit of China bonds within my portfolio as well. So that has served a nice little pickup as well. So since she has covered the fixed income, let me try to address the equity market, which is undoubtedly not so clear-cut and not so straightforward as what Lisa has mentioned for the fixed income side. Now, why do I say that? And I think Sulin's question comes in two parts. One is assessing, China's influence. And here, I kind of like to break it up into three segments. So the first segment is really about the sociology kind of an angle for China. So what we see today is that China is obviously on a very different ideology compared to the US. And that is one of the main reasons they've always been, clashing and having all these differences. Now, sociology aside, and of course, the buzzword is that China is never going to use the big C word, which is communism, but they're now talking about, socialism from a, economic or financial standpoint, right? And I think we hear a lot about that, in the impact to to especially the tech sector, the, tuition center, so on and so forth. And we can talk a little bit about that shortly. But the next thing I wanted to then dwell on as well is coming from, more of an investment perspective. And here is also where, over at Nikko EM, we see a huge polarization as well. Because on one hand, you can't say that China is insulated from whatever that's happening to, the West, when you look at tech stocks, for example. So not taking into considerations the recent regulatory environment, the pressure from the Chinese government, by and large, in general, over the last 1 year, 3 years, when tech stocks have a bit of a boom, you see all tech stocks go up, whether it's Chinese or whether it's Americans. Everyone has a bit of a nice little run. And similarly, when there's general, wobbly, kind of a tension, everyone drops at the same time. So one can start to argue for the period of time that, hey, they seem very closely related. But, back to my point again about the recent clampdown by the Chinese government, this has started to see, sort of like the ugly side of Chinese, investing again emerging. But if one were to really look at the issues that the Chinese government was trying to address, it's there's a lot of argument that it has been 4 years in the making. So while, for us as lay investors, we might panic and say, wow, why is the Chinese government suddenly clamping down on all of them? But, if you go back, they have issued warnings after warnings after warnings. And, it's not something that people who are in the know then are taken by surprise. So then the last bit about it is how is it exerting its influence on the rest of the world? And I think this week alone, there is a very interesting comment that came out of China in response to the US trade ministers and all. And China themselves said, look, stop taking us as the enemy. We are trying to be friends, but here you are, you're putting us in a position, for example, choose our 5G or your 5G. Why must it be an either or? Choose our Chinese, domestic products or choose your domestic products, so on and so forth. So I think this is where the world is really at a tipping point right now because, the long rhetoric is, do we have to take sides, right? And or do we actually, try to be friends with both parties? I know most of the audience today, you are from Malaysia, but even in Singapore, right? Because we hosted the VP, right? And when you look at some of the comments, I'm not sure if you're following, but because Singapore, we hosted the VP and all that, the Chinese netizens blame us and call us as bootlickers, right? They say that we're trying to, if I can use a bit of colloquial terms, we're trying to paw both sides, huh? We're trying to make friends with China and trying to make friends with the US. But I think that is really the genesis, or if you like, right, the end goal, where it's no longer about US being the only superpower. China is really emerging as a superpower. And I think, take it from us and Nikko EM, we think there is no doubt that they will get that. So if you're still, sitting on the fence, or you think that the Western guys will continue to be successful in suppressing China, we'd like to, put forth a slightly different point of view as well. So that doesn't quite answer though, how are we going to invest, right? Because all of us here, we kind of need to deploy our monies, whether it's us as an asset management company or you as an end investor. And I would say then, riding back to some of the points made by Karen as well as Josephine, even as you're looking at China, there are interesting things to look at as well, both from a small cap perspective, I think it was mentioned by Josephine, as well as, Karen from a diversification. So when you look at all the big tech stocks in China and all that, they really represent only a small sliver of the investment opportunities within China itself. And mind, the audience, I mean, before tech came the buzzword, we had the Chinese property companies, we had the Chinese banks, overnight or over the cycle of the last 1-3 years, not all of these companies suddenly became bad, bad investments, right? But it's just that all of us, in seeking and chasing after returns, we got so used to the 70%, 100% that Chinese tech stocks were giving us, and we're like, okay, that 20% is too little, right? So I think this is a good point in time to refocus again, as what I think Karen says, to reassess what our end goal is in mind when we're looking at China. And if there's, your investment horizon is 5 years, 10 years, 20 years down the road, there's no real reason why you need to just focus on Chinese tech at the moment. I think it's a good point in time. As the government is regulating, you see tech stocks and other Chinese stocks as well falling. It could actually be a buying opportunity to go into China. So, Lynn, back to you.
Right. Thanks, Darius. Thanks, Lisa. I can address one of the questions here to both of you. One of the questions read, how do you see the recent crackdown by the Chinese government on the Chinese tech stocks and its impact on the Chinese market, both short-term and long-term? Darius, since you've spoken about it, perhaps you could just address this question?
Sure. So I think in the short term, our answer is very, very simple. We are also watching the situation. And again, if you go down the line, right, I mean, different companies. One company, China was cracking down on it seriously because of its own, security framework, how it does handle client data. With another one, it was obviously a very, I would say, loud personality CEO who was criticizing them. So without going into names, I think you all know who I'm talking about. So I think the key thing is to really understand the issues, why each company was taken down, if you like, right? And I think if you see it for what it really is, there is some good and some merit out of it. I mean, because the Chinese government is trying to, even out some of the social inequalities. They're trying to even out some of the issues that these players become so dominant. They make so much money, but then all their vendors, all their partners are actually making, very, very thin margins. So I do think really on a long-term basis, that is a positive thing. But of course, in the near term, with all these actions, it means they might get fined. They might be forced to change their pricing models with their vendors, with their business partners. So the revenue is going to drop. But once again, I think it's not a case of, is that bad? And, we then sell out the stock. But understanding the change in the business regime that you can no longer make $10, you need to be happy making $5. But if they can make $5 and stay in business for the next 20 years, it doesn't make them a bad company, right? Rather than they stay and charge and make $10, but then the government shuts them down totally in 3 years. So I think that's the short-term perspective that you need to take a little bit of pain. But I would just go a little bit deeper to just say, things with, for example, the tuition centers and things like that, right? Frankly speaking, we don't see an end in sight. Since the government says, you can't really charge for profit anymore, there's a real cap in terms of their revenue generation ability. So I think in the short term, while all those stocks have tanked tremendously, those will be some of the sectors or some of the companies that we may not want to touch that quickly until we see what's the further development. But if you are looking, frankly speaking, on the longer term basis, there are some buying opportunities, and I think this will be a KIV kind of a space for the next 1 year, 3 years kind of view. Yeah.
Right, thank you, Darius. We'll keep some of the hot topics on stock picking and recommendations later in the day. Without further ado, let's move on to the next part then. For Josephine, we're back to her. Given that Schroders is one of the leading Asian fund managers, as we all know, what are your views now going forward? Will the markets be moving positively, flat, negatively for the rest of the year? Let's look about it in the next 6 months and perhaps the first 6 months of 2022. What would mainly be the catalyst for the markets to move? Joe?
Thanks, Sulin. We've heard much about China and the outlook on China. For us, the tuition centers have become totally a non-investable sector, and a good thing for us is that we never had any exposure to that. And for us, being a leading Asian equity fund manager, we've been able to underweight our exposure to internet stocks even since the end of last year, when the IPO on Ant Financial was pulled out. So that gave us a very good indication that we should underweight internet stocks since then. And as a result, our Asian equity portfolios have remained a bit more resilient, even though there was some correction in the market in the last 2 months. If you look at the Asian market overall, the good news is, if you look at it positively, it has now corrected. And because it has corrected quite a fair bit in the last couple of months, it is now a lot cheaper versus other strategies in the market and versus other regions as well. And of course, in everybody's mind this morning, many of you will be asking about the question on the impact of Fed tapering or scaling back of QE. So if you're worried about markets going to correct, the Asian markets for you has already corrected. So perhaps this can be a cheaper alternative if you really wish to buy something that is, get into something that is better valued and your money is better spent in terms of your investment. So in Malaysia, what we have as from Schroders, working together with our partners RHB Asset Management and providing our solutions to Alliance Bank, we have two flagship strategies. We have the Asian Income Strategy and we have the Asia Dynamic Strategy. The Asian Income Strategy, it is one of the biggest multi-asset income strategy in the market today, close to about 4 billion ringgit, has given investors a lot of positive experience. And the good thing is that it has consistently delivered about 8% per annum in ringgit, just by investing in dividend stocks across Asia, buy some bonds, buy some REITs. And right now, when we look at the Asian equity market, especially from the material sector, the mining companies, some of the banking stocks, communication services companies, we are seeing some strong upgrades in terms of dividends by more than 10% or even up to 15%. So we see this as a very bright spot and a very strong catalyst to invest in Asian dividend companies or even REITs like in Singapore or in Hong Kong, because economies are clearly reopening there. So the Asian Income Strategy is a good source for income-hungry investors, especially when your FD rate is quite miserably low for the longer term. Then the other area that we like in investing in Asia is truly investing for strong growth, high alpha potential. We have the Asia Dynamic Strategy at Alliance Bank. The uniqueness of this strategy compared to other Asian equity growth strategy is that we build in a downside risk approach. So it makes it very, very unique when markets can be more volatile potentially, or looking at uncertainties if there are any, but in the long run, you know Asia will be able to perform well, to give you that double-digit return potentially. So the Asia Dynamic Strategy has a downside protection. Right now, if you look at what we like within the country allocation, is that we underweight China because of all the issues that we're seeing. Doesn't mean China is bad, it's just that we temporarily underweight our exposure to China. But we like more in terms of Australia. Why we like Australia? Because of the mining sector benefiting from fiscal stimulus spending around the world. Upgrade in dividends as well is cheaper in terms of valuation. We like Taiwan, we like Korea, and another country that we like that has done very well this year is India. All right, India, if you remember, was a country that was dominated by headlines in terms of a huge amount of COVID cases, but India came out strongly as the second best performing market in Asia year to date. So what we're saying to investors today is, when we look at investment, don't just focus on the rhetoric, don't just focus on the noises. Try to look past and look through these noises, and you will capture a great positive experience like what you can see happen in India. It is the second best performing market in Asia year to date, even though it was badly affected by the COVID-19 cases. So these are some of the strategies, Sulin, that I have that we think will do well in the long run. Yeah.
Thanks, Joe. Thanks, Joe. It's good to hear that it's no longer just everything on China, but it's great that we can hear some of the views of diversification, especially to places like India. As you rightly pointed out, it is one of the bigger beneficiaries, given that the population is also one of the largest in the world, apart from China and the US. If I may, then just bring up one of the questions. I mean, we are all locals in Malaysia here. I think there's also some interest in terms of the ringgit, in which perhaps you could just add your view where we can hit from here.
Okay, do you want me to be honest, or do you want to be
as honest as you can?
Okay, for everybody's information, I'm calling all of you from my home in Selangor in Petaling Jaya. So I'm with all of you that have dialed in today, that we're still all under lockdown. And and cases continue to spike, and all this have surrounding us has actually affected our economic situation in Malaysia, and of course we wait for the day that the economy can fully reopen, and then we can enjoy strong economic growth all over again. But the reality is right now, ringgit continues in our view to be weak, and all the reason is due to all the issues that are surrounding all of us today. Lockdown, to sharp falls in foreign direct investment in recent years. I mean, we don't think Malaysia are getting positive FDI numbers over the recent years. And also, one significant point is that oil prices have actually gone back up from $37 per barrel to $68 per barrel in the last 1 year, but the ringgit has continued to be weak. And it's not benefiting from higher demand and low supply in oil. So all these internal factors, external factors that are affecting the country today will end up with the ringgit continue to be weak, at least for the next 1 to 2 years. And with this in mind, I think all of you should agree that it is better off to continuously invest offshore. And we believe if you do that, you'll be better compensated. So that is my very honest view, our very honest view in terms of the ringgit. I mean, versus major currencies, it will be weak. Yeah, it will be weak.
Right. Thanks, Joe. Okay, thanks for your comments. We will address some of the other questions later in the session. Lisa, over to you now. We're just a bit more focused on China, which basically seems to be all the questions that I've seen on the chat box. So within the focus on China, could you perhaps share with us on your views with the recent policy changes and also the potential regulatory pressures likely to affect the China market? In addition to that, where do you see the market for China going? Will there be just a continuous cruise upwards, or could we expect some dips? And last but not least, your views in the near term, mid-term, as well as longer term.
Okay, sure. Thank you, Celine. I think Darius and Josephine has just mentioned the impact of policy change on the China equity market. So let me focus more on the impact on the fixed income market. So despite the policy change, so far the impact of the China bond market has been marginal compared to the equity market. If you look at the months of July, when the policy change was first introduced, the China A shares was down by 8% during the month of July, whereas the China onshore bond market continued to deliver positive returns for the clients despite this kind of headline news. This is because of the liquidity injection by the PBOC to calm down the market sentiment. So from that perspective, you can see the China bond market serve as a kind of risk hedge against this kind of policy change. So Chinese government has introduced various policy to achieve common prosperity. So one of the policy including to change the private education company to non-profit as a way to reduce the education cost and to promote the birth rate in China. So the Asia market was impacted a lot because this kind of policy change will impact the operating model for those company, which is equity negative. But for the bond investors, the impact so far has been marginal because number one, the private education technology sector accounts for less than 1% of the entire fixed income universe. So there are actually only 2 issuers in this space. So this market is very small compared to equity market. And secondly, this kind of policy change won't impact the company's ability and willingness to pay. And we didn't see any significant credit deterioration for those companies at the moment. So actually, because of this kind of policy change, we take advantage of this opportunity by adding China investment grade US dollar credit into our portfolio to take advantage of the dislocated price given the company's strong cash balance. So going forward, we don't think there's any significant impact to the fixed income market because of this kind of policy change. The other thing that investors are increasingly worried about is around the property sector. we have seen a lot of cool-down measures introduced by the Chinese government since second half of last year, including the Three Red Line policy, which was introduced back in August last year to help to reduce the leverage ratio for the property sector going forward. So we think this kind of policy change is actually a good development over the medium longer run, because the company will likely to reduce their leverage ratio, which is actually bond positive. However, over the short run, we do expect to see some market volatility, especially around the weaker developers, which are heavily relying on the trust financing. So those companies will face more refinancing difficulties under the tight credit condition at the moment. So therefore, within our strategy, we have been positioned relatively defensive in the property sector in general, because we think the policy will continue to remain tight, at least for the other 3 to 6 months' time on the property sector. So we like large names with multiple refinancing channels, while we are staying away from the smaller developers, especially those B-rated developers who might face some refinancing channels with more inducing credit events going forward in this place. But despite the headline news, despite the policy change, I think one thing is that the default rate in China continue to be much lower in China compared to the rest of the world. So if you can turn to the slide, so on the slide here shows you the default rate comparison between China and the rest of the world. You can clearly see China default rate remains much lower. Last year, during the pandemic period, China has a default rate of 1.8%, significantly lower compared to US, which is more than 6%. So similarly, this year, the year-to-date total cumulative default amount in the onshore bond market is tracking very closely to the last year number during the same period. So despite the policy change, we didn't really see any significant impact to the default rate as well. But we do acknowledge the government's intention to delever the economy to achieve longer financial stability. So we do expect to see the default rate will increase in a gradual manner without causing any systematic risk to the entire financial market. So I think this is a good opportunity for clients to consider China fixed income bond market, given the credit fundamental continue to be strong. And most importantly, with more credit differentiation, it will offer us active asset managers more investment opportunity, more alpha generation opportunities by taking up the dislocated names.
If I may, could I bring Darius up to address 2 questions? Darius, one of the questions would be, with the Chinese A shares dropping from the 30% of its peak in February, would this now be a good time to buy or wait out? And the other question will be, what is the main outlook for China A shares? Darius?
Thanks, Sulin, for this very, very tough question. Since it's a Saturday, let me take out my crystal ball. Okay, no, just kidding. I think this is it's obviously a very key question that, is very dear to the hearts of most investors. But let me take the, this question and answer it from a step back, right? Because obviously when the client is asking, A shares, A shares is a very, very broad market. And as fund managers, I'm sure I won't be the only one that will say this to you, but many other fund managers will say there are the good stocks and there are the bad stocks, right? So just because the whole market fell 30%, it's not an immediate signal to go out and buy everything, but it's also not a signal to say let's dump and sell everything. However, to really, obviously, I don't want to go into the let's look at fundamentals, let's do, analysis. That's a given. We all have to do that. But I do think that in the longer term, we need to be aware of 2 or 3 trends that, will probably influence our decision on China A. So the first one is, given the current clampdown, on Chinese stocks and shares being listed on the US. So very clearly in the near term, if you want to invest in Chinese companies, and because there's such a big clampdown on the US, you are very unlikely to go and buy the US listed stocks and shares. Chinese companies there and ADRs and so on and so forth. So what does this mean? That you probably need to default back to the A shares or maybe even the H shares, right? in order to get your Chinese exposure. So this would mean, obviously, then, there could be a herd mentality that we're not buying on the US exchange. We're now going to go back to the A shares. The demand alone could drive up, the asset values. I mean, again, on the broad stroke. So that's a real question that we have asked ourselves, is this going to be a real permanent trend? From the sound and the signals by the Chinese government, that could be so. And so if that's the case, and if you're just being popped up by demand, we're not going to see the A shares sink quite a fair bit more. The other thing, obviously, is that, on the number 2 point, there are a lot more indexes that are starting to increase their weights in China. I mean, although we've been saying this for the last 3 to 5 years, it's slowly starting to happen. Started out at maybe 1-2%, 5%, but a lot of us all say, given the size of a lot of the Chinese companies, they should go up to 10-20%. So it depends which side of the fence you're trying to predict. But again, because of this demand-driven, we do expect that more people will pay attention to, the China A listings, and so as a result, we do think that, overall, the demand will still pop back, up a fair bit of all these asset values. But last but not least, also because China is, as we mentioned earlier on, trying to exert its influence. And so, I mean, in the early days, China A obviously has a bit of a shoddy reputation, right, compared to your H shares, compared to your US stocks and shares. But given that China wants to take a world global leading kind of a position, they would, enforce that the companies who list start to show, better governance, start to show more transparency, and so on and so forth as well. So with that as an emphasis, I would say that overall the quality of the listings should go up. And because when quality of the listings go up, that again will drive investors to look at those companies. You have another, demand-driven kind of an impetus for the share values to go up. Now, as all of that is happening, again, my word of caution, don't just be taken into the hype and, buy everything China A, right? Again, trust us as fund managers, and when I say us, it's not just myself, but all the houses represented today, that we will be looking at the fundamentals, analyzing what are the good and what are the bad companies. But I would say this is a more 3-year, 5-year kind of a play, because they do need time to assimilate into this new environment. So I would say it's more positive than negative on the longer term basis.
Thanks, Iris. There's one more question here on the very stock-specific one, mentioning about Ping An. It's dropped more than 40% alone. Do you think it's a good time to get into this stock or even the overall China market?
Okay, with Ping An, I'm going to tread really, really carefully, okay? Now, why do I say that? Because internally in the firm, we've been talking about Ping An for a long time, right? And a lot of the analysts and the fund managers, who have been following Ping An for the last 5, 8, 10 years and so on and so forth, they have a lot of mixed bag feelings about Ping An. Now, why do I say that? Because, again, if you look at my experience, the description earlier on, I used to work for an insurance company called AXA. Now, just to give you that perspective, many years ago, 5, 8 years ago, when you look at Ping An emerging as a superpower insurer, what they were really trying to do was they were trying to go out there and grab market share. Now, when they were grabbing market share, they were actually pricing their products very, very competitive, right? Now, however, as an insurer, and because I came from an insurance company, as an insurer, you will have to worry as well. Because why? As you take in less revenues from premiums, you still need to grow this because the liabilities will keep growing in the next 5, 10, 15, 20, 30 years. And at that point in time, there was one very worrying statistics for China, and that is their rate of obesity. So their rate of obesity was going exponential. And of course, the average premium size back then was small. Your insurers, or your insured rather, were like in their late 20s, early 30s, because that's the average demographics, right? So, all looks good. And at that point in time, a lot of people already started, to pay attention to Ping An and all that. And just because of that, they really garnered so much market share that now everyone is saying, oh, they're too big to fail. But that's precisely the part that gets us a little bit worried as well. So when you look at their revenues and all that, it's still very, very healthy, largely because they are a dominant player. And to give you a size and scale of what I'm talking about, if you compare a company like AIA, and I'm going to use this because I know the Singapore numbers and all. In Singapore, they have about 4,000 to 5,000 agents. AIA in China, they have 100,000 agents in Shanghai alone. Okay. Now, if you think about Ping An, Ping An is even bigger than AIA, so they've got more people running the ground, so on and so forth. So I think the reality is, while we are excited about it, from a real stock picking perspective, we're also trying to ascertain and understand what they are trying to do from a market leader position with regards to their product launches, with regards to their profitability, with regards to balancing out their long-term liability, because that's a very important thing. You won't see that as an investor in the next 1 year, 3 years, 5 years. So maybe if I, again, being cautious, if you like, buy now, but get ready to get out, sometime down the road, because you don't want to be the share investor holding on to their stocks and shares in 30 years time, 50 years time, when all their liabilities, have reached their exponential numbers, only to find out that they don't have enough balance sheet strength to support those liabilities. So hopefully this gives you a little bit more color about Ping An and how we feel about it. It is a mixed bag, I have to be very, very honest. Yeah.
Thank you, Darius. All right, this brings a conclusion to part 1. Maybe let's move on to part 2. Part 2 will focus a little bit more on the reopening of economies as well as the extent of vaccination rates globally. May I now bring in Karen and Josephine? In this current environment where we are facing issues with the pandemic in Asia, in China, and we were looking at how the economies are reopening now as most of the countries are tackling vaccination rates and controlling COVID as much as possible. Which instrument would you favor now in terms of fixed income versus investments in the next 6 to 12 months? So Karen, may I just bring you in now?
Yeah, sure. Could you hear me again? Is my connection
yes,
all right?
We can hear you, but your picture is not moving, that's all.
I know. It's okay. At least you can hear me. Yeah. All right. So I just want to say, I guess people are very concerned about pandemic, right? And right now, every country is kind of dealing with this pandemic at different stages and intensity. But, we're very encouraged to see that there's continual progress in the vaccine distribution. This allows economies to open up, mobility to increase, and of course, economic activity to broaden and increase as well. And with all this massive stimulus and support from the government, we really expect capital markets to be strong and very supportive to equity investing. And given that bond yield has been so low, like I mentioned earlier, right, investors just can't rely on fixed income to grow or build any wealth anymore. And there is no alternative, Tina, right? But to look at equities, yes, risk, remains on the horizon. But, investing in capital markets is never a straight line. And also thanks to strong earnings growth, robust earnings growth, we consider that, yes, while stock valuations are not cheap, but we still believe that there will be more gains in select equities if clients are selective on what they invest. And at the end of the day, we advocate balance. We think that, investors should always consider income and growth assets. But I also imagine that a lot of Asian investors are very fixed income heavy, very fixed income centric. I would advocate for more growth or equities. And also, I believe if you buy equities that are COVID or macro resilient, quality business that will enjoy sustainable or competitive advantage would definitely enjoy long-term durable growth. So try to look for companies that have the ability to grow profits and do well regardless of how the environment is doing. And in short, yes, equity looks attractive, and valuation wise also is very supportive for more equity investing. Over to you, Joe.
Yes, Joe.
Thanks, Karen. Yeah, so Lynn, like I've mentioned to everybody earlier, we still prefer equities and also commodities. So for equities, to be a little bit more, to give everyone a clearer picture, we'll share our views based on regions and why we like it and why we don't like it. So if you look at the biggest region in the world in terms of US equity, do we still like it? Despite the fact that certain parts may be a little bit expensive, but right now we still are very much in favor and we remain positive in the US because of the economic expansion, and typically the US market have very, very good quality names that can still be that are also very defensive. So we continue to like US equities. But there's one area that we like a bit more in terms of regional equity would be in Europe. European equities, a lot more cheaper than US in terms of valuation. And why we like it a little bit more versus US equities is that vaccination rates continue to surprise to the upside. And we are very confident that Europe will not go into any other lockdowns, even going into winter. And also earnings of companies are coming back very, very strongly. And of course, with a better, cheaper alternatives in terms of valuation, the upside can be quite pretty good from European equities. In Asia, I've shared with you earlier that it is one of the market that has corrected recently because of the issues with clampdown in China that took place a few weeks back. And what are the more favorable markets for us right now in Asia? We spoke about Korea, we spoke about Taiwan, because the manufacturing outlook remains very bright for these countries, especially with the low semiconductor inventories that are in high demand, and which allows a good environment for these two countries. And of course, Australia, we spoke about it just now. Fiscal stimulus is very, very beneficiary. India, again, I want to remind everybody, though the market is expensive, but there remain a lot of attractive companies, despite the fact that COVID was an issue back in April. That's the areas that breaking down by region. But there's one other area that I want to share with you guys is other than equities, we also like commodities, and particularly we're more positive on energy, the oil sector, because of strong demand driven by the reopening of economies around the world and very, very, very tight supply. Another area of commodities that we like would be to industrial metals. So demand, especially outside of China, continues to pick up very strongly in this climate of global recovery and global expansion. So for commodities, energy and metals would be something that we like a lot. Actually, I saw a question about gold.
Yep.
And since I'm covering commodities right now, gold, we continue to remain a bit more neutral. We were more positive last year or the year before. Maybe a little opportunity for price to rise, but I think we think the current level will still continue in terms of the gold price. So we remain rather neutral in terms of gold. Yeah, that's all from me.
Thanks, Joe. Yeah, thanks, Joe. I mean, all the sectors that you've mentioned actually goes in line with the theme of inflationary pressures as well. I think commodities, as you mentioned, energy names as well as the gold can basically address that particular theme. Let's move on to tech now. Again, it's the same topic that we've spoken about, but in the environment of the pandemic, there's been a lot of supply chain disruption. Is there anything that you can add before I let Darius take over the queue?
I mean, yes, I mean, this is a reality. The supply chain disruption is also the result of a high demand for semiconductor chips as a strong progression in terms of Internet of Things, 5G development, and also, the electrification of the green technology that is all happening around us. So, I mean, in our view, a company like TSMC will continue to do well. We still like this area of the technology hardware that we are seeing. Like I said, we don't like the internet stock so much. We are off from AST stocks. But in terms of technology hardware, this is an area that we will continue to favor and remain to be one of our bigger focus in terms of tech investment in Asia and globally. Yeah.
All right, thanks, Joe. Now let's move on to Darius, since he's the tech expert here, and given that his fund is the big ones that everyone's talking about on the disruption. So how has the tech sector been affected during the pandemic? And then, as like you mentioned just now, supply chain is disrupted. How positive can we be towards the tech sector as the economy reopens? And I know it affects also plants in Malaysia that affects global players like your Motorola's and a lot. So over to you, Darius.
Okay, thanks. I think the reality is, I mean, I don't want to dwell too much on this really because a lot has been said and a lot is known. But I think one thing that has not really been brought out is the fact that, you know, with all these disruptions, with all this, you know, shortage and supplies and all these other things, it actually creates a very polarizing situation. So on one hand, you see, as what Josephine mentioned, Taiwan Semiconductors, you know, Samsung Electronics, all these are the leading players in, you know, your semicon industry. So while they also have had problems trying to meet their, you know, the quota, the numbers that they're supposed to produce, guess what? Because they are so popular, they're so in demand, and they're best of the best, they can raise their prices. So I'm sure many members of the audience would have known about this, you know, where they are raising semiconductor chip prices. But of course, then this also means that on the other hand, you have your second tier players, your third tier players. These will be the guys that struggle as well. So one of those things is that as you're looking at the tech sector, I mean, from a supply chain management, obviously then you need to know who are the better players, who are the ones that, you know, are able to increase their prices, you know, so they are able to protect margins a little bit better. So then you make a slightly more informed choice. But I think when it comes to tech, I think a lot of people's main question is, oh, should we still be buying the Googles, the Amazons, the Yahoos, and whatnot have you? So with that, I want to just invite the control people to just pull up this slide for me. And this is really regarding our fund per se. So I want to land a slightly different angle in terms of, you know, how we look at technology, and you know, we wanted to just put it in the context of our disruptive innovation kind of a categorization. If I can have my slide, please. So as they are pulling up my slide, broadly speaking, you know, we usually have 5 different sectors that we talk a lot about, and that is AI, energy storage, robotics, DNA sequencing, blockchain. So one key area that I wanted to really just broaden people's horizon today is that when you think of stock, yes, for the Internet of Things like your Amazon, Googles, and all that continue to be very, very important part of our daily lives. When we look at tech, I mean, from an investment perspective, we are also seeing, you know, tech more as an enabling platform. So what do I mean by an enabling platform? So if you take AI, for example, and you combine it with robotics, you get everything from, you know, adaptive robotics, you get 3D printing, and you get a whole myriad other, you know, form of sectors and business models. So what this really means is that if you take tech, for example, in our opinion, a 3D printing company is also considered a tech play because they are working with the technology, they are further enhancing the technology to something more powerful, to something more applicable and widespread across different industries. So likewise, I mean, if you take AI and you combine it with things like DNA sequencing and all that, that's going to majorly affect the healthcare segment and not just IT companies per se. So the genesis of where I'm really going with all of this is this. While you are still seeking some kind of exposure, you know, in terms of your big FANG names, you know, some of the Tencents, Alibabas, and so on and so forth in China, there is actually a whole bunch of other opportunities that you can get exposure to when you're looking at technology per se. And to give you, I mean, slightly bit more concrete examples, because obviously this segment we're trying to understand what happened, you know, in the COVID period and how does this relate to investment. Many of the investments here that we have, just to give you one good example, is this company called Teladoc. Now, Teladoc is a pharmaceutical company. So for lack of better comparison in Singapore and Malaysia, that will be our Guardian Pharmacy, our Watson's equivalent. So Teladoc doesn't do research on drugs and so on and so forth. But what has happened during COVID is because of, you know, AI, because of the Internet of Things and all that, they started to see people buying medicine online. Because in the US, people will typically take the prescription, go to the pharmacy company and queue up and buy the medicine. But because of the COVID, they can't go to the pharmacy, and buy, so they have to start ordering online. Now, what happens is before COVID, only single digits, so maybe 9% of their clients buy medicine online. But because of COVID, that number has gone up to 50%. Now, of course, we all think COVID will end at some point in time. But what is very interesting is that the companies have also said that, with a lot of all these things, it's a behavioral thing. Now that I'm so used buying medicine online, do I really want to go and queue back at a pharmacy company to buy my medicine down the road? I say this as well as a very personal, anecdotal thing from an individual. I started using apps to order groceries, 3 years ago. In the last 3 years, I have not stepped into the supermarket chain physically. So I've not gone to NTUC, cold storage, etc., etc. So where we're seeing is that, with COVID, definitely have benefited some of all these other so-called tech. I will call them alternative tech, if you like. And we think that there will be a much longer term effect as well, because people's consumption habits have changed, will change, and this bodes well for the broader tech industry as a whole and gives us options to not just only focus on, the usual big FANG stocks and all that. So with that, I'm happy to also open it up to the other ladies on the call, maybe Josephine, Karen, or even Lisa, if they have any thoughts or comments on the big tech companies per se.
Joe, is there anything you want to add? Since everyone's so quiet.
Maybe I can add a little bit from the fixed income perspective. So TMT sector accounts for a very small portion of the China bond market, less than 1%. So far, this kind of policy change didn't really impact the bond market as a whole. So from the credit fundamental perspective, we think a lot of companies actually has very strong standalone credit position, profitability, and rating headroom. So we didn't really see any significant downgrade for the TMT companies in this sector. We think the VIE structure maybe more pronounced for the equity investors rather than the bond investors. So within our portfolio, we are still comfortable with the large TMT players, especially those being rated as A-rated by international rating standards.
Okay, great. Anyone else to add anything else? If not, we'll move on to the next part where Lisa, you will then be the next speaker. All right. If none, Lisa, let's move on to you. Similarly, in the topic of the pandemic and in China, what can we learn or what can we learn in the Chinese market throughout the pandemic and how they've actually encountered it? What are your views on post-pandemic views on the China market, given that we are currently getting towards an exit level of the pandemic? Lisa?
Sure. So China is the first in and first out in pandemics. If you look at back in 2020, China is probably the only major economy which recorded positive GDP growth of more than 2.3% last year, which is still leading the rest of the world during the pandemic period. At the same time, if you look at the vaccination rate in China right now, 75% of the population has been fully vaccinated. So China has done pretty well in terms of controlling the pandemics as well as in terms of the vaccination rate. We think the successful story from China is mainly contributed by two factors. So number one, the government has take a zero tolerance approach for this entire issue. For example, when the pandemic first happened in Hubei province in January last year, the government quickly locked down the entire region and conducted tests for everybody in the city to control the viruses. And secondly, the government has taken a lot of preemptive measures. For example, the PBOC was the first central bank which conducted aggressive monetary easing as early as January last year to stabilize the market. At the same time, the government has also window guidance the local banks to reduce the funding cost for small medium enterprises during the volatile period. As a result, back in 2020, the China bond default rate is just at 1.8% compared to US market, which is more than 6%. So China economy is very resilient, and the Chinese economy is more domestically driven. If you look at the fixed income space, the exposure to COVID-related sectors like transportation, hospitality, energy is much lower in China compared to the rest of the world. So the fixed income market in China is extremely resilient in the pandemics. So over the medium and longer run, we think the Chinese government will focus more on the structural issues, including reducing the social inequality, reducing the financial property risk, improving market transparencies. The government also set a very easy GDP target this year, only 6%, which is very easy to achieve. So this means the government will prefer to focus on quality of growth rather than the quantity of growth. We do expect to see the GDP will slow down in second half of the year, given the latest wave of the Delta variant, and as well as the credit tightening measures in the property sector. So because of that, we think the PBOC will take a moderately easing monetary policy stance in the second half of the year. So this will actually create investment opportunity for clients, because we do expect to see the onshore yield will drop despite the rising US Treasury yields. So the onshore market will provide investors capital gain opportunity despite the sell in the US rate market till the end of the year. So from that perspective, we expect to see more triple R cut in onshore with targeted liquidity injections. And from that perspective, we think China bond really offers a type of resilience for clients who are increasingly worried about the rising US Treasury yields and also worried about the equity market is at all-time high.
Great. Thanks, Lisa. Without further ado, let's move on to another topic of interest, which is ESG, environmental, social, and governance. And for this, let me bring on Karen. In this issue of the pandemic, before we go totally specific on sustainability, what have we learned from a sustainability angle throughout the pandemic, and what are your views from an investment standpoint in terms of strictness of investing in ESG instruments? I mean, that basically corners quite a number of funds and stocks, because there's just not many around which are fully ESG compliant. And then also, in your view, how have these instruments outperformed? Because I think from the FTSE for Good and the FTSE MSCI index, a lot of them have mentioned that as long as you are ESG compliant, there's a very high chance that your fund or your index may outperform normal indices. So over to you, Karen, to address these views.
No, certainly. Thank you, Sulan, again. So I guess you're right that, this COVID-19 pandemic has actually brought to light a few things, right? That today we're more reliant on technology, right, to work from home, to allow us to conduct this webinar via Zoom, to allow our children to do home-based learning despite all the lockdowns. The deficiency on global healthcare has also been exposed during this period. And I think more importantly, people are slipping into hardship and poverty as we speak, trying to deal with this COVID crisis. And also at the same time, we are looking at global population increasing from 5 billion to 10 billion in 2050. And what it means is that there will be more homes to power, more people to feed, more healthcare needed, and more goods and services to produce. And at the same time, many countries are also committed to this, net zero carbon goals. And how are we going to do that, right? We're truly living in a planet of crisis. But very often, crisis creates opportunity. It presents opportunity. And as the Chinese word, 危机, right? So in every crisis, 危险的时候, you need to be aware of the danger, but at the same time, you want to be attentive and take advantage of the opportunity, the 机会 that it brings along. So company that can provide the innovation or bring about solution to tackle some of the world's biggest challenges will also see themselves enjoy the world's biggest opportunity. Right, so if you could bring up the chart on the UNSDG, please. Can you bring the slide, please? Thank you. Thank you so much. So in 2015, right, the United Nations actually gathered 193 countries and asked them to list down some of their challenges and priorities which they hope to tackle by 2030. Is essentially, what is their aspirational view of the world in 2030. And out came this 17 United Nations Sustainable Development Goals, UN SDG for short. And these 17 goals, sorry, they are very small, but these colored boxes, there are 17 of them, right? They are to address some of the social problems, as well as abating climate issues, to improve access and affordability to quality healthcare, to eradicate poverty, zero hunger, and to empower the minorities by bridging the digital divide, as well as to address some of the inequality that we see. And the cost of achieving this 17 UN SDG goal represents 90 trillion, which means it's a massive investment opportunity for private investors and capitals like you and me, right? And because there's only so much your government and charity could contribute capital to try to advance some of these goals. And in simple terms, it means that company that could bring about innovation and solution to advance these 17 goals, right, to tackle the climate, health, and social issue will have massive growth and opportunity. And we think it's going to be one of the most exciting investment opportunity of our lifetime. The next slide, please. Now, very often, right, investors will associate strong profits, strong growth, to the economic health of a country or to the GDP of a country. So in this case, we see that the US GDP, the expected growth, right, it's going to be 6.5, which is no means a small number. And in fact, it's one of the strongest growth that we have seen coming out from the US in recent memories. But if you look at the other bars, which represent some of the sustainable themes that presents itself in current environment, you can see that a lot of these growth trends or sustainable themes are enjoying very high, strong, and very long-term growth potential, much higher than the 6.5% GDP growth that we see on this chart. So if you look at the digital payment and the internet traffic that's represented by the blue bars, you can see that they're riding on very important secular growth supporting e-commerce and cashless payment that's very, very helpful for us in this lockdown environment. And tech enables and empowers small businesses, right? And enables small businesses to do business with consumers regardless of where they are, and this will help them to build financial resiliency and inclusion, right? And enables to find employment and build wealth. So all these sustainable themes that is displayed on this chart are truly enjoying very long-term and very durable growth that are macro dependent. And they're able to grow, like I said, whether, the global GDP is doing well or not, whether the global economy is expanding or shrinking. And, more importantly, like I said, there is also a lot of commitment of 193 companies trying to advance some of these 17 UN SDG goals. So today we think that investors have the ability to do well and at the same time do good. And there is also often a perception that by doing well, you need to sacrifice return. That's not true. In fact, some of the sustainable strategies, given that it's leveraging on this very strong, long-term, durable growth that are macro independent, they are able to do well regardless of the macroeconomic environment or government actions or policies. So, back to you, Solin.
We can address some of them now. One of them includes what is the view of the feasibility and the outlook for green technology stocks in the US in line with Biden's plan. And there's also another one to ask on the view of on climate, whether or not that can be addressed. So Karen, let's just start with the one on the green technology first, and I'll repeat the other question later.
Sure, definitely. So, I mean, at AB, when we think of, portfolio with purpose or sustainable investing, we essentially, look at the 17 goals and come up with these three buckets, and one of it is climate. And within that climate, there is a lot of sub-themes underneath. And, clean energy, sustainable transportation, renewable energies all kind of fall under that. So that's very, very important. And also maybe to link up to that 1 trillion, that infrastructure plan that, that we've been talking about. We think it's very, very exciting because while some of these secular trends or these sustainable themes will have long-term, growth potential, these stimulus support, right, from government in the US provide very strong, powerful short-term stimulus as well. So in the Biden infrastructure plan, he is also focused on, some of these key areas that we have within our portfolio, which is climate. So renewable energies is a bit of it, right? So to advance, the wind projects. So that's a key part. So it will obviously, benefit a lot of these companies that manufacture or service these wind turbines, right? Vestas, for instance, or companies that provide these component parts that enables, right, us to have more green or renewable energy, right? Electrification of vehicle is certainly one key part. Healthcare is always key, regardless of which country that we talk about. And I think they are committed to also improving quality healthcare, improving accessibility, affordability of healthcare to the US person. It's also about, providing capital and research capabilities to company to advance some of their research effort to give us more targeted medication, more advanced medical innovation, right, to help us on that front. And more importantly, right, it is shocking to hear that a developed economy like the US still have over 35% of Americans that do not have internet access. So I think one of the goals is to also bring, affordable, reliable, high-speed broadband to the American citizen, because technology is an important enabler for people to have education, to, go do business online, for cashless transaction and so on and so forth. So we're very, very excited about this, Biden infrastructure plan because, like I said, it's certainly supportive to some of the sustainable investments or portfolio with purpose, right? So, because a lot of the trends that we looked at is definitely very forward-looking, but they are here to stay for the long haul. And like I said, the investment opportunity to advance some of these goals is as big as 90 trillion. So there's a huge role that private capital can play in here. And I guess, to my earlier point, right, companies that bring about these solutions or innovation will see strong financial return, which then create very, very big investment opportunity for investors like ourselves.
Great. There are two more questions in the Q&A box which I'd like to address since it's related to ESG. One of them says, what is the impact of ESG and climate factors on investments? I mean, it actually narrows down the scope, as I mentioned just now. Your views, Karen, please?
Sure. So, at this point, I like to also, differentiate between ESG integration, right, as well as portfolio with purpose, sustainable investments, right? So ESG integration essentially is integrating environmental, social, and governance factors into your investment process, besides just looking at the financial books, right? And at Alliance Bernstein, we integrate ESG consideration into all our investment process, regardless, it's equity, fixed income, or multi-asset solution. So besides looking just at the financial statement and their financial books, right, we do consider it as and G factors, right? So this helps us to manage risk better and mitigate risk and deliver better investors' outcome. Now, in the case of sustainable investing or portfolio with purpose, like the fund that I'm talking about, right, the global sustainable thematic, it is investing exclusively only on the sustainable themes, which I'll address in your further question later, right? And these themes are, obviously aligned to the UN SDG goals that we talked about. And, we want to invest in company that will have, products and solutions that will enable a more sustainable environment. So it's very, very different, and hence the difference between an ESG integration versus a sustainable portfolio. So you only invest in companies that not only, in the case of sustainable investing, that is, not only, focus on the financial results and the financial outcome of what the company can do. The company must be able to also contribute positively on the social as well as on the environmental front.
Great. But as you also mentioned, the other part that wasn't addressed so far yet is the outperformance of the performance of such ESG funds. In your experience so far in the past year or so, have you seen these funds or these companies outperforming most of the the old-fashioned type of companies that really do not really put ESG as a forefront of investors' themes?
So, past performance is no form indication of future returns, but I guess if you are investing in a company or a portfolio, right, that drives some of these long-term sustainable trends, right, I think they are going to be quite resilient to this economic volatility and sell-off, because healthcare, right, it's never going to go away, right? Even though we are entering into recession, people will still need medicine to get well. They will need treatment to, feel. And also the extension of healthcare is also now beyond just treating your illnesses. It's also about well-being and good health, right? And it could be also investing in a company like Nike that's promoting healthy living, and athleisure trend will stay regardless, right? Fat is going to taper, whether we had this regulatory crackdown in China. People are still continue to favor, company that could advance some of these crises and solve some of these challenges that we're going to face for a long time. Abating climate, the effects of climate issues is going to stay. As we speak, in Singapore, we're experiencing one of the heaviest rainfall in the month of, August, September, which is very, very unusual, and we haven't seen that in the last 40 years. So, like I said, some of these trends are not going away, and in fact, the recent COVID only highlight the urgency of tackling issues in healthcare, in climate, and also poverty, income inequality.
Right.
So I feel, Sorry. Go ahead.
Yeah, no, there's one more question here on hydrocarbon. It was just posted up. How do you see the prospect of hydrocarbon energy in the next 10 years till 2030 and compare it with sustainable energy? Is there any policies to prohibit the usage of carbon-based energy?
Well, so this is definitely a key topic, and in fact, as we speak right now, right, we are potentially looking at, a China carbon neutral strategy, right? Because China has committed to reducing their carbon footprint and being a carbon neutral, and they have this big plan surrounding that in 2060. And it's true, it's an ongoing thing, and there will be further research and work done on it. And also, it's also interesting to learn that actually, while enabling electric vehicle, right, to be made possible, some of these electrification of vehicle is still powered by carbon. So it's an ongoing research there. I'm afraid I don't have enough depth to really talk about it, unlike my specialist. But it's certainly a big topic, and you can also see countries like China, right, looking at this subject matter very, very carefully and closely, and this hinges on a lot of their policies in the next 10, 20, 30 years or so, and this is not China alone.
Great, thanks, Karen. Now, before we move on to addressing the China ESG and the carbon neutrality stance with Lisa, I'd like to bring in Joe again, because to answer a question on CPO outlook. So there's a question up here saying that what are your views on Malaysia's CPO outlook, and on how do you view the prospects of this particular sector? Joe?
Okay, at least thank you very much for the question. I'm very happy to answer this, because at least this is potentially something more uplifting for the Malaysian economy. Fundamentally, we do think that CPO prices will be quite strong for a couple of reasons. Number one, if you look at production of the yield, the palm oil, it has fallen quite a fair bit, close to about 10% year on year versus the same time last year. And in fact, it is the first time ever since 2017 that production has gone down so low. So as a result, and because of higher demand, tight supply, we have a bright spot. I mean, we're looking prices to be moving uptrend, moving in all the way to 2022. And at the same time, soy oil prices have gone up. So as an alternative, the demand for CPO has also, as a result, the demand for CPO also increased. As a result, higher oil price, magnifying a potential for higher CPO prices. So pretty good outlook, at least for the next 6 months to 1 year in terms of crude palm oil prices. I hope I answered the question. Yeah.
Okay, I think the other issue with CPO and palm and also the prospects of it is, if you were to bring in ESG into the picture, I think we are also caught with quite a bit of labor issues, as well as how sustainable CPO is and how this affects the global market as a whole. Your views on that, perhaps, if you were to put in a tinge of an ESG angle.
Well, of course, when we invest in sustainable investment, we look at stakeholders, and stakeholders are represented by the environment, employees, the regulators, the communities around us or around the companies that it serves, and the shareholders, of course. So with regards to crude palm oil, I mean, maybe Karen can add in as well. With regards to crude palm oil, I mean, in this particular region, I mean, there's stuff like open burning, and then land replacement may not be an entirely sustainable, fully sustainable choice for us in terms of investing in palm oil. But I mean, when we talk about sustainable investing, which Schroders has been doing for more than 20 ESG and sustainability investing, which Schroders has been doing for more than 20 years now, covering about 13,000 companies in terms of ESG assessment. Looking at the broader picture, there's a lot more companies and opportunities to look into, while this particular sector needs a bit more time to deliver the sustainability approach that the ideal sustainability approach that we as fund managers would like to have. We look at other alternatives for the time being. Yeah.
Great. Okay, thanks, Joe.
Yeah.
Let's bring in Lisa now, from the perspective of China's ESG stance, and at the same time, since we're talking about this, what are also your views in terms of the ESG performance of some of the China funds? If you could mention both fixed income as well as equities, if you can. Thanks, Lisa.
Sure. I think first of all, China is very serious on the environmental protections, as we are seeing aggressive policies to back this up. The government wants to achieve carbon neutrality by 2060 and to increase the share of renewable energy to 20% over the next 5 years. So right now, China has the second largest green bond market globally with a size of 1.3 trillion RMB. At the moment, close to 50% of the green bond issuance in China has met the global standards like the green bond principles. So we expect this will offer a lot of investment opportunity for global clients who are looking for sustainable investment, especially in the China fixed income space. So from the portfolio management perspective, ESG is fully integrated across all the China-related portfolios because we think ESG provides us very useful non-financial risk information to help us better understand the company's fundamentals. So for example, in late 2019, we didn't invest into a Chinese high-yield rental company due to the poor governance, including the key man risk, the lack of data transparency, and the lack of rationale over aggressive expansion. Subsequently, the bond experienced significant drawdown due to an accounting scandal at an affiliated company with the same largest shareholder. So from this example, you can clearly see incorporating ESG into an investment process can help us make much better investment decisions.
Great. I think BlackRock is one of the key pillars and the key proponents of ESG, not just in China, but globally as well. Okay, now this brings us to the end of part 2. On part 3, which we will start shortly, we'll be focusing more on the topical issues of sustainability as well as tech. And may I now bring in Karen again to share your views on your sustainability funds. More importantly, it's what we've spoken about earlier on what's all about and how you put things in and how important ESG is as a consideration for investments. How do you then market such products? Because it's new to investors. Not many people are aware what ESG is about. So let's talk about a little bit more about marketing the products and how do you bring in clients' interest in buying those funds. Karen?
Absolutely. Thank you again, Solin. So again, like I said, ESG integration happen all across all AB fund, regardless which asset class you're talking about. But the fund that we're discussing right now is a portfolio with purpose, which is the sustainable global thematic. And actually, where I mentioned also earlier that in this case, this fund invests exclusively only on sustainable themes, right? And sustainable investing is actually a competitive advantage because, like I also mentioned earlier, companies that are aligned themselves offer very, very good financial opportunity, which then creates large investment opportunity for investors like us. So, it really has dual goal. While it tries to allow investors to earn, very attractive financial returns, but also allow investors through investments in these companies, they are able to do something for the world, right? They can invest in companies that contribute positively to these factors, socially or environmentally, and help the entire world. And because the alignment with positive change, these companies are aligned with positive change, we think it helps to drive their long-term growth for the business as well, right? So this is enabling a more sustainable future. So we see 3 buckets of opportunity, and they are in climate, healthcare, and empowerment. And in these 3 buckets, there are a number of sub-themes that are very interesting and investable. And once we identify these themes, right, we will actually outsource the definition of what sustainability is to the United Nations, and out came this 17 UN SDG. And underneath this 17 UN SDG, there are about 169 sub-themes, but not all are investable, and not all themes, it's where, private capital has a role to play. So we will try to look underneath this 169 themes that are committed, right, by the 192 countries. So, that really informs our investment footprint, our blueprint, so to speak, our roadmap. And then after that, we will narrow down to about 50 companies that are in the portfolio. And each single company that we pick must fit into one of the sustainable themes. And it also has to stand on its own as good investment. So through our bottom up, right, when we pick these 50, 60 companies, we try to take a long-term approach. We think like business owners. In fact, we take a very private equity approach. We build business model out for 5 years, and we will also consider the risk of each company very carefully. Besides environmental, social, and governance risk, we looked at operational risk, we look at financial risk, we look at the strategic risk, and eventually we will only pick companies that give us the best risk return mix, and those are the companies that make it to your portfolio. So in summary, right, sustainable development is really about, not just making the world a better place, but it's also about, generating economic growth in such a way that it doesn't destroy the environment. And also these benefits are not shared by only a few people, but can be broadly shared throughout the society. We really don't want anyone to be marginalized, and are able to reap the benefits of these investments.
Okay, thank you, Karen.
Thank you.
Oh, so do you want to say something else?
No, I just wanted to say that, I think with such a portfolio, right, you are actually able to future-proof your investments, because you are really aligning yourselves to very long-term sustainable trends.
Right. Okay, great. Thank you, Karen. Now, I think we've ignored Darius for a little too long. Back to you now. In terms of the outlook of the tech sector, and at the same time, we will address some of the questions we've been posted up for the tech sector. So, Darius, over to you now. Do share your outlook on the tech sector. I mean, we've addressed it many times, but in your view now, if we were to take a step deeper into the subsectors, which of the subsectors do you see that's more attractive? And do you see a bubble coming, given that we've seen some of the tech stocks moving up and down? It's very volatile.
Yes.
But from where it is, what are your views from here? Thanks.
Thanks, Solin. I don't think the audience mind ignoring the thorn among the roses for a while, but just to be the one that helps to round off this whole conversation, I think the biggest challenge, with the tech sector today is definitely regulation. Because so many of all these tech giants, if you like, they've grown so fast, so big that, governments all around the world are starting to get a bit worried about their control, about the influence that they have, and again, you see this from, presidential elections where people can post about things, so on and so forth, down to even say Australia, for example, where the governments want all these Facebooks and all these other people to pay media companies because of all the content that they generate, but these guys are all just freeloading off it. So I think we're still in the infancy stages, because I think the last thing that the governments also want, knowing how much influence is in these tech companies, is to really do hard and fast measures. But that being said, I would say if there's any government that's a little bit more reactive and quicker, it will be the Chinese government. Because as we all know, the Western world, when you want to do something, there's always going to be a lot of lobbying, so on and so forth as well. So while you may not see immediate impact or reactions to things like Amazon, Facebook and all, I will almost say rest assured, they will come at some point in time. The only question is then, as we're invested into it, what is the real genesis and the real purpose of that stock or that sector being in our portfolio? All right, so that's what I wanted to just comment on the big tech. Now then, going down the line about all the other so-called, whether you're talking about hardware, software, for example, applications, so on and so forth, there will generally be quite a fair bit of I would say, competition among companies. So the impact on those different breakdowns that I just mentioned, we feel that with the above overhang of regulation, with the real sheer I would say natural resources in terms of where you're located. What I mean by that is, for example, in most parts of the world, Amazon is very used, right? But we all know in Japan, Google is used, but in Japan, Yahoo is the one that's dominant, right? So it comes down to when you talk about tech, there will be certain biases, due to geographical locality. So the US, for example, will still use your Googles and all that. China will still use all your Baidu, your Weibos, and all these others. So I would say this is actually more opportunities for us, because then we can, kind of balance our weights out. As investors, we don't need to put all our eggs in one basket. But I think what is very interesting and where we see the most opportunities to finally bring a finality to this is, actually looking at AI, artificial intelligence. Because for all the things that was earlier talked about by even Karen and all these others, whether you're trying to solve climate problems, whether you're trying to solve water problems, whether you're trying to solve social economical problems, guess what? Today, the key to doing that is data. But when we produce so much data, the reality is you need that glue to join everything together. And we think that AI is that glue to join everything together. And because of that, that's how we're going to get more sustainability. That's how we're going to get more, economic, I would say, prosperity, so to speak. And we will truly level out the playing field. I mean, whether you're talking about from an education perspective, from a healthcare perspective. So a lot of the companies, and so to bring it to the point about how we then invest monies, right? So we're not just saying, okay, because of AI, I'm going to buy semiconductor companies because they produce the chips. But no, there are companies that we can actually look to invest, because while they take that AI, they are also furthering the AI in terms of algorithms, in terms of applications, so on and so forth. And then they're thinking about, with all of these, how to make their companies more efficient. Now, I just want to talk about one example with Tesla, for example. Now, we all know that they're now into self-driving cars, they're into self-driving trucks and all that. But how does that play into a sustainability theme? Now, in the US, there's a lot of people that are boycotting them, saying that, look, if you go into this autonomous trucking networks, you're going to put all these truck drivers out of a job. So how is that serving your equality kind of a sustainable goal that Karen mentioned about, right? But Tesla has actually said, look, we're not putting truck drivers out of work. We're going to retrain them. Because the truck while it's driving by itself, it might still break down. The tires might puncture. So we need a truck engineer, a guy who knows how to now solve the onboard problems, fix a car tire, so on and so forth. So there's actually further opportunities for them to be retrained, upskilled into just beyond a truck driver. So I think this is very, very key, where we see tech kind of like as an overarching, binder, if you like, to improve all these factors. And I mean, while I'm not saying that, please mortgage the house, switch 70% of it into tech and all these others, I would say that, tech will still be a nice part. So even if you're buying a bank, even if you're buying, your consumer discretionaries or consumer staples, know that somewhere, somehow, there is already a tech representation in it. And, then of course balance the pros and cons accordingly to your risk profile and, your time horizon for your investments. Yeah. Hope that answers the question, Sulin.
Yes, it does. Okay, there are three questions here that's particularly aimed at you. First of all, is what is your view on Nikko Asset Management Singapore Dividend Equity Fund? There's another one on your view on the Affin Hwang Global Disruption Fund, and last but not least, the same one on the global disruption. So these are the two, your views on the two funds, on the Singapore Dividend Equity Fund as well as the Affin Hwang Global Disruption Innovation Fund.
All right. So I would say that for the Singapore Dividend Equity Fund, I won't use the word bullish or anything, because, come on, it is Singapore, right? I mean, we are a tiny red dot, it's going to be always...
Kiasi, okay?
Yes, but again, I think maybe specific to what the fund is trying to do is we're trying to do, we're trying to give the clients who are invested a very stable income outcome. Now, what do I mean by that? And I think this is not so much of a Singapore view per se, but what we're trying to do with the fund is at the end of the day, right, we declare a dividend the year before. So frankly speaking, in November, December, there will be a dividend committee. I'm actually part of that committee representing sales. Fund managers are there, product people are there. We will say what we're going to pay next year. So let's say next year we're going to pay 5%, right? We discuss about it, and if it's 5, we take 5, divide by 12, and we pay it, next year on a monthly basis. Now, obviously, though, that Singapore as a dividend culture, our companies only pay 3%, 3.5%. So those astute investors out there, you'll be wondering, hey, you take 3.5, how do you pay 5? So at the end of the day, the fund managers do have to make capital appreciation such that when we pay you the income, you don't see a huge fall in the NAV. So with that, what I wanted to say is now going into the view, how are the fund managers actively repositioning the portfolio in order to get that capital appreciation? So earlier on in COVID, we recognized straight away that there will be some losers, obviously, within the Singapore market, and there will be some winners. Winners will be people like your Singtel, for example, because people need broadband, people need to increase. I mean, I don't know about your investors, but I definitely had to up my subscription plan, right, in order to get a more stable broadband network, etc. But yet the laggards will be all our good old SIA, for example, tourism and all these others. But now, 1.5 years, almost 2 years after COVID, we're starting to see a bit of shift and a move towards from the laggards into the growth, and maybe those that were benefiting moving a bit more mainstream. So this gives us a bit of opportunity to start to resize the shape and size of the portfolio itself. So what I'm just saying in practical examples is that we may not have bought a lot of SIA last year. This could be a time where we slowly think about inching our way to SIA back to 0.5 to 1%, for example. So I hope this gives a good illustration that we're not saying that Singapore as a whole is going to do much better, than say Malaysia or India and what have you. But because by and large our constitution is slow and steady, I think we will get there. So especially for investors who are more interested in the income outcome of our product, I want to give you the assurance we will still be doing our utmost, and you should be able to see the proof in the pudding as well. Now, moving to the disruptive innovation, obviously that's one that has seen quite a fair bit of turmoil as well, because it ranged upwards and then it's collapsed a little bit and then it's gone up a little bit. So again, depending on time frame as well, if you bought in closer towards the highs, you may be still a little bit out of the money. But, insofar as what we've seen, Kathy and the team, talk about their stocks and shares, talk about their positioning. Earlier on, when I talk about AI, that's exactly what they're trying to do with the portfolio. So in 2020, coming into 2021, we actually had a good run-up in terms of a lot of our healthcare stocks. So what we've done is we've taken, profits off some of the healthcare, and we started to reposition it into what we call, the internet, kind of stocks and shares. So it's not so much your Facebook, Amazons and all that, but it's a lot to do with things like your digital medias, your e-commerce, so on and so forth. I mean, one of the companies that we've actually put some monies into is actually even into Zoom, right? Because we continuously see that, this platform is being used by a lot of people for meetings, for webinars. And last but not least, because even as we're inching out of COVID, I'm sure the situation is similar in Malaysia. Most companies now have, survived COVID. So they're also relaxing their HR policies to let people work from home a bit more, compared to the past where you have to clock in 9 to 5 every day in the office. So with that, I mean, you're not going to see Zoom usership, right, go up because of COVID and then crash land again, post-COVID. So we think this is now the new way of life. And we're really looking at taking opportunities in some of the stocks and shares where people have enjoyed that convenience that I talked about earlier on, and will become kind of like almost mainstream in your life going forward as well. Yeah.
Great, Darius. Okay, we've reached almost 1.5 hours of all of your time. Thank you so much for your patience. Let's take some conclusion remarks from all of us. But let's just start by saying that, again, thank you everyone for being with us for the last 90 minutes. If we may start with Darius, again, since you were the last to speak, let us continue with what you have. Just a 2-minute wrap from what we've said so far, and then we'll move on to the next person.
Right. Okay, so I guess if I can have my slide up, I wanted to do two things. One is just talk about from a disruptive innovation perspective, right? I think looking at this particular strategy as a whole, it is a true source of growth. From clients who are already invested or who are not invested, do look at our fact sheet, do talk to your bankers as your relationship managers. You will realize that our stocks and shares are very, very different from most of the other tech or global equity multi-asset portfolios out there. So this, in conjunction with all the funds that are represented by Josephine, by Karen, by Lisa, I think you will achieve a very good return on the moderate or high risk reward kind of a profile. So I would say don't be disheartened by what's going on in the marketplace today. Really relook your strategy, rebalance, and then strive for growth. In the next 3 to 5 years as well. Thanks, Sulin. On to the next person.
Right, Joe. Haven't heard from you for the past 30 minutes. Let's hear from you now.
Yeah, thanks again, everyone, for joining us today. We have spoken about many strategies, and obviously, for us is for all investors, who are Malaysian investors of Alliance Bank. Bear in mind, remember that the ringgit will continue to be weak. The better bet for you is to invest offshore so that you are better off compensated over the medium to the longer term, and we believe markets will continue to be able to trend upwards. We are all bottom-up stock pickers, and this is where we will be able to find the best opportunities for you to make meaningful, positive returns. So what we're saying here is count on us and stay invested in the long term. Right, that's all I have. And of course, stay safe always. Yeah.
Thanks, Joe. Karen?
Mm-hmm.
Thank you. It's been a great 90 minutes. Typically, thematic fund has been perceived by investors to be risky, volatile, because it's niche, it may go out of fashion. But we think a global sustainable thematic strategies like ours, where it's invested globally, diversified across different themes that are evergreen. It has the ability to demonstrate longevity in clients' portfolio for a long time. So I actually think that investors could potentially consider it as a core building block in your portfolio, because these sustainable themes, like I mentioned repeatedly, they're very strong and durable growth potential, and is supported by a long-term secular trend. And these trends now have further strengthened by the COVID pandemic. And the investment opportunity, let me recap again, is 90 trillion big, right? So there's a role for investors like you and me to play, and it will translate into massive investment opportunity for companies that are well aligned. And this is one way to really, bulletproof your portfolio, your asset allocation, and it offers investors a very diversified pattern of returns as well as growth opportunity. Thank you.
Okay. Thanks, Karen. And last but not least, Lisa, your concluding remarks.
Yeah, thank you. 3 key takeaways from my side. So firstly, we think China continue to remain the place for income. If you look at the cross-border China strategy right now, it is yielding at 7% in RMB term. Even on dollar hedge basis, it is yielding close to 4% after taking into account of the hedging cost, with the average rating BBB minus, which is investment grade rated, and the duration at just 2.6 years. So this 4% dollar hedge yield is actually comparable to US high yield equivalent, but with an average rating which is 4 notches higher compared to the US high yield. And what is more importantly, the annualized volatility for this strategy is just at 2.4% annualized over the past 5 years, compared to US, which is at close to 10% in terms of the annualized volatility. So from the risk-adjusted return perspective, we think the China cross-border fixed income strategy really offers clients the highest risk-adjusted returns, and is increasingly being recognized as an evergreen solution with high income, low volatility, and low drawdown. The second key takeaway I want to highlight is on the correlation part. So for the clients who are increasingly worried about the Fed tapering, we think China bond offers a perfect hedge, given the PBOC will like to take a moderate easing to the end of the year. So China and the US have very different economic cycle, so they serve as a hedge against each other. For clients who are holding a lot of global fixed income assets, adding China actually makes a lot of sense from the diversification perspective. And what is even more, within the China, the correlation between onshore and offshore is also very low, which can enable us to generate very strong performance by doing tactical allocation across these two markets. And finally, the China credit profile continued to remain very resilient. Default rate continued to be quite low, tracking closely to last year's number. We think there will be more credit differentiation going forward, which will create a lot of alpha opportunity for our clients by taking advantage of the dislocated price.
Okay, thanks, Lisa. Now, this is a concluding, before we end the day, I think Darius has a little gift for us. Darius?
Thanks, everybody. So I guess as the theme, I mean, you can see at the top left-hand corner, looking beyond the turbulence of 2021, right? It's the worst over. So given that, we've seen so much turbulence, a lot of us may see the cup as half full or half empty, if you like. But I hope after listening to all of us today, you kind of have a little bit more information, and, with that, I hope, your investing journey will be a pleasant and a much more fun one for the rest of 2021 going into 2022. So with that, thank you, ladies and gentlemen. Take care and stay safe.
Thank you, everyone. So we've addressed almost all the questions, perhaps another 8 out of 30 that we didn't address. Apologies for that. But we hope you found this session very fruitful and happy investing, and stay safe, everyone. Thank you.
Bye. Thank you.
Bye.
Thank you so much again. Stay safe.
So nice. So that concludes the discussions. A big thank you to the panelists for the insightful sharings. Also to valuable customers, thank you for your participations. We hope you find the event fruitful and informative. Next comes our lucky draw sessions. Today, we'll be giving 2 prizes with 500 ringgit worth of unit trust each and 1 grand prize of 1,000 ringgit worth of unit trust. As a reminder, we have included your lucky draw number in the reminder email. Shortly, a number will be displayed out of the screen. If that's your number, please provide your name, contact number on the chat box for us to come back to you. We'll now run the randomizer. When I say the lucky number will appear on the screen. We shall start with our first lucky number now. Let's spin. Stop. Okay, the first lucky winner is 11318. That's our first lucky winner. And let's move on to the second lucky number. Spin. And stop. So the second lucky number is 11428. And congrats to the second winner. And now comes the most exciting prize. A grand prize of 1,000 ringgit worth of unit trust. Let's get your number ready. Okay, we shall start. And stop. The lucky number is 11155. Congratulations to the grand prize winner and all 3 lucky winners. We have actually more prizes to gift. For you who has RSVP and spend your time with us today, you'll be rewarded with a MDA approved oximeter if you decide to invest with us after this event. So the promotions start from the 6th of September to the 10th of September on a first come, first served basis. Do find out more from your relationship manager on the details or scan the QR code at the end of the sessions. Leave your number for us to contact you. And also, we would like to share with you some of the current campaigns brought to you by Alliance Privilege. So also do contact your relationship manager after these sessions or scan the QR code to leave your contact today for a complimentary portfolio review and find out how to redeem your oximeter. Thank you everyone for joining. Wishing you a wonderful weekend. Bye.
Alliance Bank. We have discovered that true wealth lies not in the world or what it can offer. True wealth lies in the hard-working hands of a dreamer. True wealth is being around people who add meaning to our lives. These are the people who are always there for us, in times of success, and even in challenging times, they're always there. We have learned that through all of life, family is the one constant, and Alliance Privilege is just like family. Helping individuals tell their stories, helping families achieve their dreams, and helping generations share their legacies. Family and Alliance Privilege. The future's always better together.